So here we are for our second podcast, really going into some of the details. We hope you have watched and enjoyed the trailer or the pilot episode that we did about a week ago. It was released on Monday, the 1st of June, and here we are on the 3rd, Wednesday, the 3rd. Great to be with you again, Mitch, up there in Joburg. How's things there by your side today?
Winter has kicked off in Joburg. So we've got some overcast weather, and it's reminding us that it's winter. So, yeah, but we're good. We're good.
Well, it's blowing. I'm checking again here, blowing a gale here in Cape Town. Perhaps not a surprise, but also a sense that winter is coming. Great to be with you again, Mitch, and hope you've been keeping well since the last time we talked. And a quick summary of what we did on the pilot was really introducing both of this idea of you are the expert in the field. You're working as an accredited financial advisor. I've been a client of yours for in the region of, I think, 20 years. We've been working together, and the end result of that is I have options at the minute in terms of, which is great to be 55 and have options in front of me around my savings and investment career, if you like. And what we wanted to do is to share with other people who might be thinking about or considering investment options, to talk about some of the basics, some of the fundamentals that are not necessarily talked about in the classroom or around the family table. And one of the things I wanted to kick off with today was this idea of the value of a rand. And before I ask you to give your sort of sense of what does that mean by the value of a rand today versus 10 years time or a decade ago? Whereas, so many people, I think, often think around currency, the idea of currency and the rand against the dollar, rand against the pound. And just to put it in context, when I came out from the UK in 1994, it was 5 rand to the pound. And I think now it's up somewhere at 22. It's been as much as 25, I think. And that's a metric where you say, but the rand's losing value. But actually, that may be losing value against foreign currency. But it's also about the internal machinery within South Africa of what the rand was worth in 1994 and what it could buy you, and what a rand will buy you in 2026 are two fundamentally different parallel universe, if you like. So to you as the advisor, talk to me about your understanding of the value of a rand and why it's such an important sort of foundation stone of any conversation about investment.
Yeah, so that it's such an important concept to understand. The reason being is exactly like you said, in 1995, what 1 rand could buy you compared to what it could buy you today is night and day. Fair enough, everybody was earning a very different salary at that time.
Sure.
However, when you are investing into hard assets or investable assets, you are giving up today's purchasing power, so spending that rand today. And the trade-off over certain amounts of time is that those assets will grow over and above the inflation rate that's eating away at the purchasing power of that rand. So the 100 rand today is very different to 100 rand even 5 years ago, because of how inflation is eaten away at what you can buy with that rand. Okay, so with investing in bonds, cash, both locally and internationally, you always want to know that when you're investing over a period of time, that you're going to get more money than you put in, but very importantly, that the money that you're getting returned to you after a 10-year or 15 or 20-year period has grown in real terms. So what I mean is, now the 1 rand you put in will buy you double what that 1 rand would have bought you 10 years before. So often when you look at investment, let's look at a 10-year period. If you look at an investment chart of a typical South African balance funds, and over the episodes, we can go into the details of the different options that are available to individuals. But a balance fund is relatively well known because a lot of our retirement products have balance funds as the underlying investment structure. So a typical balance fund over 10 years has averaged a net return of around 10% per annum, which equates to about 2,000. So 1 Rand would be 1,000 Rand. Let's use 1,000 Rand would be worth 2,400 Rand today. Of that 2,400 Rand, you've got to take away about 1,400 Rand for inflation. So,
Right.
And the real growth actually is 1,000 Rand of everything that you've. So of the full 2,400 Rand, your 1,000 Rand is the real growth, the extra purchasing power that you have gained by investing. And that's in essence what compound interest does, but also why it's so important to understand that you have to have investment returns that are above inflation so that you can get more back than what you put in.
To put it in sort of an anecdotal way, if I had 100 Rand in my back pocket and I put it under the mattress, isn't that the old classic? I put it under the mattress and I pulled it out in 10 years' time, I'm going to find my ability, what that 100 Rand could have bought in a shopping basket, significantly different over that decade period. If I put it into some sort of investment approach, it could be property, it could be bonds, it could be any range of different solutions. Ultimately, that you would want to have it pegged at the very least that it's grown in its value from the original 100 Rand, and you're using that example of sort of about 2,400 on a basic investment of 1,000 Rand over a 10-year period. So, I mean, the idea of putting your money under a mattress might be useful. Maybe some of us put it in couches, but that's another story for another day. The bottom line being that in doing so, it's diminishing on a daily basis. Is that a fair and reasonable assumption?
100%. So let's look at an example. So 10 years ago, let's say you're buying a Coke, 2 liters of Coke. You would have paid, let's say, 10 Rand for 2 liters of Coke. That same 2 liters of Coke was probably going to cost you 18 Rand now. So the 10 Rand that you've kept under your bed has lost that 8 Rands worth of value in real terms. So you that same 10 Rand can't get you the same Coke that you bought 10 years ago at 10 Rand. And that, in a nutshell, is exactly what inflation does to the value of your Rand. So finding methods to improve the purchasing power of the money that you store is essential. So that's the basic of compounding interest. Is you have this compounding effect if it's interest, if it's growth, or it's a combination of the two. But the net result over the period that you're targeting you need to be in assets that can grow your purchasing power. Otherwise, there's no point in investing. You need to have a goal of growing purchasing power over time.
To maybe differentiate, if you can, between this sort of consumer price index or CPI that we sometimes hear about, and then other inflation aspects, whether it's around food, housing, transport, etc. Just talk to me a bit about those variables that economists, investing advisors like yourself would be taking into account.
Okay, so it boils down to monetary policy and the mandate by the Reserve Bank. So the Reserve Bank has a mandate to keep inflation within a narrow window. If it drops below that window, interest rates will go down. If it goes over the average rate of return that they are targeting, interest rates will start to go up. That is sort of a high level look at it. Although most of the markets will track the bigger markets like the States. So if inflation in the States starts to go up and our inflation is relatively benign, because the difference between interest rates in different countries makes such a difference, we always want to have a more attractive interest rate in our bond market than in the States, so we can keep some money in the country. Okay, so that's going into the details, but let's go back to CPI.
Sure.
Okay, so CPI is a basket of consumer goods that is tracked by the Reserve Bank, and like I said before, if that basket of goods starts to go above a certain rate, they will start to increase the interest rates. So it is the tool that the Reserve Bank has at its disposal. Some might say it's a very blunt tool because in our basket, it doesn't exclude things like oil and housing and food. And if you look at it, something like oil, we got no control over the price of oil. So it doesn't, interest rates usually rise when the economy is heating up and prices are rising. But if an external factor like oil or the rand, for instance, blowing out and causing inflation happens, it is not a behavior by the people in the country where they are paying higher prices because the economy is getting hotter. It's an external factor. Okay, so that but in a nutshell, that is how our inflation is tracked and kept under control, and that's why interest rates go up and down.
So, I mean, a really good example right now, we're seeing the impact globally of the oil, I don't want to call it crisis, this oil issue in the sort of Persian Gulf relating to the US's intervention in Iran, and that's having knock-on impact. Got nothing to do with us.
Exactly.
Yet it has everything to do with us in terms of the impact that's felt across all the commodities, the cost of driving from point A to B, public or private transport are all impacted. So there's, I think, an example of where that's, as you say, not taken under consideration through this consumer price index per se, but is a fundamental impact. And I mean, whether we're in, sorry, you go.
So it's an interesting topic because we used to have an index called the CPIX, where things that were affected from the macro environment outside of South Africa, like oil,
right,
were removed. But the current mandate of our Reserve Bank is that they use the CPI index and that basket. And if food is affected by oil, so be it.
Understood. But I think the critical thing here is in relation to, and we'll get to the cost of lending and the cost of borrowing rather as a consumer. As those interest rates goes up, for those who have savings, good news, because that's going to ultimately increase your return and retirement pot. But if you have debt in relation to a car, in relation to a property, that's where we start to see things pinching. And I remember very clearly 1996, 97. Correct me if I'm wrong, Mitch. You probably got probably studied this in your exams. 20% interest rates. I remember colleagues talking about the fear factor of having to lose their properties. These were professionals, many years in the game, but at 20%, their bond repayments completely blown out. And I remember some of the early calculations for my first property. It was sitting there going, if it's I think it was around 10% at the time, 15%, and factoring the worst case scenario in. And luckily, I don't think we've been anywhere near those rates. But every time we hear a couple of basis points, or in real terms, percentages increase, we know that's going to have an impact on the ability of, what do we call this thing now? Sort of the income, available income, household income, which is available for anything other than essentials, your accommodation, your food. Disposable income. Sorry, there you go. So yeah, anything else you want to touch on around sort of CPI, the inflationary aspect
around that? So remember, I said to you that I worked in restaurants up until the late 90s.
Yeah. We talked about that in the last episode.
97, 98, I hired an engineer that used to come work at night as a waiter to keep his house. So sort of grasping how things work and the extremes that can happen is very important when you're looking to sign up and get debt. When you are purchasing something on debt, it's really an important budgeting exercise. Actually looking and saying, okay, so if everything goes well, this is a good deal. However, that 20% of the time when things go really badly and the interest rates go up to X again, is what I'm purchasing affordable? It's such a good exercise to have whenever you're taking out debt.
I don't want to get into the economics of elasticity and all these funky words, but it's how much have you got before the band breaks because of the challenges. And Mitch, one of the other things that I think is a big problem, and I guess I'm going to differentiate here between the public sector and the private sector, is this idea of salaries tracking inflation. Often in the public sector, there's a sort of cost of living adjustment that comes in. Obviously, in the private sector, those are conversations that are held across the table, I would assume, in most instances, where you argue for your pay increase, or the company will say, we're not in a position to increase salaries because of the economy, because of factors. But what happens when, not only is your savings impacted by inflation and the interest rates affecting that, but also this when you're not necessarily getting that increment on a year-on-year basis from a salary point of view? That's obviously something else that's, I guess, very important for everybody in employment.
Yeah, so anybody getting an income, it could be from employment, it could be when you retired, managing your budget around things that are increasing, and then having a situation where your employer just simply can't afford or doesn't want to give you an increase can be really, really tough on a consumer. It's really tough on the consumer. And then, unfortunately, most people turn to debt to fund that gap. And you see a lot of articles in the financial papers and online talking about consumers digging themselves in this hole. And unfortunately, once you start, it's very difficult to get out, especially if your income from the beginning wasn't covering costs. Now you are paying interest rates, usually prime plus 3, 4, 5%. And that interest is just growing and growing, and this hole is digging deeper and deeper. So I was talking to a new client yesterday, and in a company she made 2 years ago, she made some decisions, and now it wasn't well thought out, and there's consequences. Right. So just as taking 100 Rand 10 years for 1,000 Rand and investing it for 10 years and getting interest, making a bad decision, usually what it does is it compounds over time. So when you are doing your planning, when you are thinking through these things, you've really got to sort of move that marker forward to see what are those consequences that you're looking at. and try not to make decisions out of emotions.
And I mean, we'll get into it in future episodes, particularly around this idea of risk. And I mean, that's always part of the conversations you and I have had around, what's the appetite for risk? And mine's typically very conservative. And that the point that you're making there, I think, which is really important, is that it's like being at the casino. You're putting your investment into a particular risk category, and the higher the risk,
Please,
or the higher, I guess,
quote unquote, the
emotion, the higher
the. Not a casino, Pete.
Am I getting it wrong? That's
no, it's not a casino, Pete.
Tell me I'm wrong. Tell me I'm wrong. Tell me I'm wrong. It is. You're playing the markets versus playing the.
No, it's not a casino.
Tell me.
So the casino.
That's why we're having the conversation.
Okay. The house always wins, Pete, at the casino.
I know that. Oh, yes. Okay. Now you're going to tell me in the investment game, it's Alice is right.
Yeah. So in the investment game, it's not a zero-sum game. So what I mean, I'm actually glad you brought it up like that, Pete. I really am, because it's not a casino. And it's not a zero-sum game. So what I mean by a zero-sum game is that there's not a winner and a loser. So when you're investing in a company, and it's a basket of companies, both locally and internationally, and in different sectors and different disciplines, you're not like purchasing a burger and you eat the burger and it's done. You are investing in the future earnings of that business, so the future growth. You're investing in the management. Okay, so over long. Okay, so we got it. So that's another episode. What is a long period of time for investing? So it'll be an interesting exercise for us. But pessimism usually runs rampant throughout the media because it sells. The blood on the street sells. But in actual fact, things have been getting progressively better over time. So if you're investing in a broad basket of equities, both locally and internationally, because things are getting better over time and there is growth, you will participate in the growth of those shares. Okay. So it's not like a casino where it's 50-50 and you're probably going to lose your money.
Understood. But again, correct me, and this is, I say, part of why I'm enjoying this conversation, and the platform is there for it. So when 2008 comes along and the housing debt crisis in the US essentially tanks global markets, people lost a lot of money there, and lost jobs, and the whole impact, the implosion of a particular, what would you call those things? That debt that was so attached to the bond market there.
So it was debt instruments. Yeah.
The debt instrument. What I constantly see, there seems to have been limited learning on that. That some of those products are still available, and so the point being that the ability and the confidence that you have to have in relation to a product. Someone like myself, I have no idea. I've watched, was it The Big Short? I thought that was a really interesting take on that. And, it really woke me up to, some of the, how damaging that would have been for not just those who were buying the properties, but, the reason that the markets collapsed and the damage that was done. So, I mean, am I right in saying, and this is probably a big stretch, and perhaps it's an episode in its own right, my sense there was that somehow South Africa was shielded from the very worst of that because of some of our banking and financial disciplines that we installed. I speak under correction. That's the sense I had. We saw at that period, South Africa was still going through a fairly, or was coming off the back of a huge residential boom in those early 2000s, where we saw big parts of Joburg and Tshwane or Pretoria growing at a rapid rate through townhouse development and so forth. And that did come to I don't think the building rates have necessarily ever matched that prior to 2008, but we certainly seem to ride the worst of it. Am I right, or am I talking absolute nonsense?
So you are right, absolutely. So what happened from 2000 to 2008? Because the pessimists were proven wrong by 2000. So we had emerging market crisis in 1998, where we saw the blowout of all emerging market crisis currencies. As far as I remember, it was linked to Russia defaulting on their debt just before the
Right.
USSR sort of collapsed. Details don't matter.
Hungary as well, if I remember correctly. Hungary was another of
The
those that
Eastern
I think
Bloc
was.
guys, all the Eastern Bloc
Yeah.
guys. So everything linked to the USSR. But I mean, that was the cause at that moment. So we have these black swan events as we go. The 2008 financial crisis, 2020 was COVID. Although the way the monetary response changed a lot of things, but it has created a lot of debt. So getting back to why we were shielded, because our debt to GDP at the time was very low. So we had really good fiscal responsibility. Unfortunately, we then went into the Zuma years. And then our debt to GDP has risen considerably since that time. So our safety net has fallen away. And the Rand in a free market, and the market is showing that there's risk in South Africa by the Rand being weaker, if that makes any sense. So it's a barometer for how the world sees the management, which is our government, running this business, which is South Africa. Okay. So that's the barometer that's happening at the moment. The 110% are other factors, and the macro factors, such as the dollar index at the moment. The dollar is really strong for all the for their management is making a lot of noise, as everybody knows. The big orange head, as you said. What did you say last time? So yes.
I think I was putting that kindly on.
Yeah. Okay. So the point of the matter is, guys, is when you're investing, you want a diversified portfolio, and the underlying
to spread the risk.
To spread risk. Yes, exactly. So it's one of the foundational principles of investing. So there are layers. So the next layer would be then watching costs within that portfolio. Then the next layer would be tax efficiencies that you can create, which is actually your biggest cost. But those are details that need to be gone into. But the first,
we'll get to that.
Yeah, we will get through the detail. You know me, Peter. I love the detail. That's my favorite. I love the detail. I love putting it together so it's got a good picture. You're saying?
But it starts from that old adage of, don't put your eggs in one basket, right? I mean, it's like that old saying, and it holds for this as well. Mitch, I want us to start bringing us to a bit of a summary here. Now, the one thing we haven't talked about is I mentioned a 20% rate, I think, of interest rates back in those mid to late 90s. Talk to us about some of the rates that we're seeing currently in terms of CPI, in terms of inflation rates, and what are sort of the margins that you as an advisor are looking at, so that people who are sort of saying, yeah, I know, I sort of hear these things on the radio, I hear them talked about, I hear or read on the back pages or whatever it might be, on those scrollers on ENCA or whatever, if this is what's happening.
Oh, yeah.
What are some of the numbers that are important right now, and what people who are listening to this should start taking an interest, if they're interested in this conversation? What should they be watching for on a more daily basis or weekly basis, for that matter?
Yeah, so it depends on the person. So, what are the big things that's on that feed is oil and the Rand dollar. So if you see that start to go up, if the Rand goes up and the dollar price goes up, we're probably going to have a cycle of 18 to 24 months of price increases and the pain that brings. Okay. So those are good things to watch. What I typically watch, because the American markets affect us so much, I'm watching what's happening
Yeah.
on the ground in America. So their manufacturing index, their inflation. Because if their interest rates go up, our interest rates will definitely go up. So
Understood.
we saw an interest rate come up this last week or so. And in my mind, what I could see, it was a preemptive measure, because all of a sudden the core inflation in America hit about 3.7, which is really high for them. So then we're probably going to look at interest rate hikes coming through instead of interest rates decreases, even if Donald Trump is saying that he won't allow it, because the bank is independent. Well, it has to remain independent, otherwise that's a whole another level of pain. But their mandate is to keep, their main mandate is to keep inflation in check. And
What is the
inflation,
lending? Sorry, Mitch. What is the lending rate presently? I didn't mean to interrupt you. Sorry about that.
our lending rate,
Yes.
I think it's 11.25. I'm
Right.
not 100% sure. I'm not a banker, so I don't go and apply for rates for clients. However, so I have a client that runs a huge property portfolio in Joburg, and it's shopping centers. So when he needs money, when interest rates start to go up, he starts taking money out of the company investments,
Sure.
and lowers the interest that they're paying by balancing that out. So somebody that's even an individual, if you've got a house and that is 30 or 40% of your monthly spend, it's something that you need to be mindful of.
Oh yeah, 100%.
Mm.
Mitch, let's leave it there for now. I think this has been great. This has been, again, a sort of scene setting around this idea of how important it is that the single rand that you have, the 100 rand, 1,000 rand, what it is today and what it will be in 10 years' time, irrespective of what's happening around the world, is going to change and is going to decrease. And that is the way that money works. And so we've got to be mindful of that. I think the next conversations we'll start getting into also, what is the impact of an interest rate on the ability to save or to bring down costs? And I've used that example in the pilot of, a mortgage over 20 years where you pay over the rate that you have been asked on a monthly basis. You can bring the repayment schedule down by years quickly. But by the same token, heaven forbid, if it goes the wrong way and interest rates and you're paying for the car or whatever that commodity for a much longer period at a much higher rate. So those are some of the things that we'll get into in the next one. But for now, any final word in summary of, summing up the conversation we've had in 2 or 3 bullet points for people to think about?
Okay, so bullet points, here we go. If you got money that is left over, you wanted to put it to work. If you're going to put your money to work, you need to know what their purpose is and how long you want to put that money to work. And then that's how you develop a good investing plan. Thanks, Pete.
Thank you. Great summary points. Always enjoy the conversation, Mitch. Many thanks for your time. Have a lovely rest of your day. Keep warm.
You too, Pete.
Speak to you soon.
I will do.
Cheers.
You too. Ciao.